Okay, just about to start. Welcome everybody. Let everybody get on board. Okay, so we're talking about behavioural mechanics, which is the mass psychology of the market. People driving the market rather than fundamentals and technicals, and it's proved very, very successful over the years for me. I'm Jody Ellis, and I've got a bit of a bio there that you can read through at some time. It's a no advice session, so it's general information only. It may not be appropriate for you. I'm going to tell you what I'm going to do and things that I have done over the past years with Melbourne Cup. Now, there's no warranty or guarantee by Investor Centre. We're not liable for any losses or damages arising from any information that we give here, and it represents what I'm going to undertake in the marketplace. In viewing the presentation, you accept full responsibility for any action that you take resulting from the information presented. So we'll just talk about what is an index for people who aren't quite sure. An index is composed of the top shares in a sector or a marketplace. So the index that we're talking about today is the Australian Top 200 Index. The ASX code for it is XJO. And it's composed of the average performance of the top 200 stocks by market capitalisation. Now, the top 200 stocks in the Australian market represents about 90% of total dollar turnover in the market every day. So there's more than 1,700 stocks listed on the Australian market. The top 500 is 95% of those. The top 200 is 90% of those. And the top 20 is about 40% of all money turned over in a day. So whilst we have a broad market, we've got quite a small number of stocks that power the entire market. And a lot of people don't realise that you can trade the top 200 index. Now, we trade with City Index, and we use the top 200 December CFD from City Index. And we've been doing that from 2007. Prior to that, we used the share price index future from the futures exchange. Now, I talk about that a little bit. There's some differences in the SPY, the share price index future, from the Australian Stock Exchange and the Australia 200 December CFD. But the Australian 200 December CFD from City Index for Investor Centre clients is an exact replication of that share price index future. Now, if you don't have a City Index account, you can contact admin at investorcentre.com.au or phone 1300 132 999 and speak to administration there, and they can actually organise a City Index account for you to do what we're going to do here. The advantages of an index CFD is that an index actually has no fundamentals. Because it's the top 200, we're not worried about what's happening individually with Westpac Bank or with ANZ, or we're not worried about Telstra going down because it's having some bad times with 5G, etc. We're looking at the direction of the overall market. And with the CFD, we can have a guaranteed stock. That's sensational. We can limit our liability at any time. And so we don't have an unlimited liability. And with an index, we've got no real inside trading. Knowing everything about BHP or everything about Commonwealth Bank is no particular advantage in the index because it's diluted among the top 200 stocks. Now, the index also trades 24 hours a day, 6 days a week. So we're about the first market to open. Don't have to say New Zealand. We're the first major market in the world to open at 9:50 Monday morning. And then we go all the way through to 7 a.m. Saturday morning. And that trades with a couple of breaks. There's an hour break here and a couple of hours there during the days. But literally, we trade 24 hours a day. And our stops, our normal stops, work through that time. We only need a guaranteed stop when we're going to trade across Sunday. The big thing about an index for us as small traders is it's no disadvantage and it's an even playing field. In fact, I'll go so far as to say small traders benefit from trading the index because large players in the index broadcast what they're going to do before they do it, and they are easy to spot and hard for them to get big positions very quickly. Small traders can get quick positions very quickly and they're in and out. You don't have to worry about Australian liquidity unless you're trading with more than $2 or $3 million. Once you get to that level, your instant liquidity starts to get a little bit harder. But up to that point, if you're just doing individual trades on the index and you're in the sub $100,000 per trade zone, then you're in and out instantaneously. Okay, now if you think about the top 200 index, it's a herd mentality. We're using 200 cows to represent the entire herd, and we don't have to work out what the BHP cow is doing or the CBA cow. We only have to work out what the herd is likely to do. So BHP cow might go somewhere in the paddock, but if the majority of the cows go up, and we know they're going to go up into the trees, then we can actually just go long the index. BHP cow might want to drink and it goes down to the bottom of the paddock. It can behave differently to all the other cows, and that doesn't affect us. All we have to do is work out what the majority of the cows are going to do. And then all we have to do is solve the equation of what's going to happen to the group. Now, it's a straight out case of human psychology. We solve what the psyche of the people are, and we know which way the market's going to go. Now, there are black swan events where suddenly something happens, there's some military action in the world, or we have some sudden event that affects the market that we aren't aware of. But mostly the market, and we say 5% of the time we have abnormal conditions, and 95% of the time we have normal conditions where normal group behavior dominates the marketplace. If we've got in the top 200, we've got 100 stocks going down and 100 stocks going up, then we say there's basically a neutral stance in the marketplace. It's going sideways. If we've got 50 stocks suddenly going down, but 150 stocks going up, we've got a bullish behavior in the marketplace. If we've got 150 stocks going down and 50 stocks going up, then we've got a bearish dominance in the marketplace. And if we can work out what is the likely general behavior of the market, then we can actually make money from it. Now, before we start on this, I'll tell you how Trading Tigers came about. And this is a Trading Tigers trade that we're about to do. It's in fact, you would regard it as the signature Trading Tigers trade. The trade which has the highest probable outcome. Now, back in the late 90s, I moved from options and into futures for hedging my own portfolio. And I noticed every year at Christmas time that the market would go up. We call it the Santa rally or the Christmas rally. And in the broker industry, it's been known for a long time, the Santa run. But the problem with it is you can't tell which stock is going to go up. Will it be Telstra? Will it be ANZ? Will it be Westpac? What sectors will go up, etc., etc. Varies on what's going on with those stocks in the year. But in all that time, Christmas ran up, and I could see it going up constantly. And I thought, why are some stocks worth more at Christmas time than at other times? When I came to futures and started trading futures, I realized I can trade the index. I don't have to work out that. That's very hard to work out. But if I can work out where I'm trading in the index, that's very easy to resolve. So I go long the index at Christmas time. That's the second most popular trading Tigers trade. The thing that really made me think was I noticed in 1999 at Melbourne Cup, our market went very bullish. And then in 2000, I went long in the Melbourne Cup. I had an excellent win, and that started me thinking about, why would our market be better on Monday and Tuesday than Wednesday for Melbourne Cup? And it shifted my whole paradigm of belief. Up until then, I'd been 90% technicals, 10% fundamentals, and I realized that both of those systems have value, but really, we're not trading BHP, we're trading the people that trade BHP. We're not trading Wesfarmers, we're trading the people who trade Wesfarmers. And when we put them into an index and we're saying we're not trading the top 200 stocks, we're trading the people that trade those top 200 stocks, it suddenly opened a curtain for me, and I realized that working out how people feel affects the market at a much higher level than the individual fundamentals of the stock. Now, I know that the people will argue against fundamentals or technicals, but you can't argue that the value of BHP or ANZ or the top 200 stock is what somebody will buy it for and somebody will sell it for. And the consequence is it's powered by people. Now, we think about Melbourne Cup. First off, in the finance industry, Monday is a relatively passive day in the marketplace, the first Monday in November. Secondly, we go into the first Tuesday in November, and unfortunately that is RBA Tuesday, but this RBA Tuesday is pretty much a non-event because we're expecting zero activity from it. The event for the Monday and the Tuesday is going to be dominated by the Melbourne Cup, where the majority of Australia stops. Now, this is particularly true of institutional fund managers and people in the broking industries, where they have client functions, they speak to clients a lot, they're talking about the market, they're talking about the Melbourne Cup, etc., but they're not actually trading. So the market goes to thin volume from Monday afternoon through Tuesday, and the dominance in that market becomes a buy scenario. The market is predominantly bullish through that Monday-Tuesday period. Now, we can actually look at it and we can go long on Monday prior to Melbourne Cup and run through right through to Tuesday afternoon at 4 o'clock, and we see on light volume that buyers overpower sellers for that time period, even when the rest of the world is going down. So, Melbourne Cup, you can enter at 1:30 Monday afternoon, that's Sydney time, AEDT, before Melbourne Cup, and you can take up 3 targets. The first target is obviously the easiest target, and we call it the 25 point is the soft target, the 40 point target is the easy target, and the 70 point target is the hard target, right? And only problem with this trade is you really need to select your target before the trade starts, because during the course of the trade, it will spike up to that point sometime, and we really don't care if it's 1:35 Monday afternoon. In fact, that's actually better. And so the sooner we get our points, the happier we are. Now, $1 on a 25-point target will pay $25. $2 will pay $50, etc. So the normal target that I choose is 40 points, and then we have a stop, and we always have to have a stop in the marketplace. It's critically important for long trades. So I put a stop at 70 points below my entry, and our exit is just before close on Tuesday if none of the targets that we're after is actually met. Now, what we're going to do is quickly, over the next couple of minutes, just run through the history of the Melbourne Cup through 2001. Now, the statistics of Melbourne Cup trade go all the way back to 1983. But in 2001, the Melbourne Cup trade was different because it was XJO and not the All Ordinaries Index. So I'm just going to run with XJO. Prior to that, the All Ordinaries Index was the SPY. It worked there, and if anything, it worked a little bit better than the XJO, but we're just going to use the XJO because that's what we'll be using on Monday. And if you went long for 40 points, you achieved 40 points. Obviously, if you went long for 25, you got that as well. And if you went long for 70 points in 2001, you got your 70 points. In 2002, the 25 points was achieved. The 40-point target in 2002 only netted you 4 points. In 2003, your 25 points was achieved. Your 40 points missed, and you only got 18 points out of it. In 2004, your 25 points was achieved very early in the piece. 42 points still achieved you 25 points, and you went very close to going all the way to the end on that one to get the 25 points. In 2005, you got the 40 points was achieved, and if you went for the 70 points instead of 40, you got 48 points. In 2006, 40 points and 70 points were achieved. In 2007, 40 and 70 were both achieved. In 2008, your 40 points achieved you 40, but your 70 points, if you went for 70 points, that gave you 26 points net. In 2009, in the middle of the GFC, your 40 points gave you 40 points, but your 70 points actually lost you money, and you got 22 points, a 22-point loss for that. Melbourne Cup in 2010, your 25 points was okay, your 40 points and your 70 points both achieved 5 points. In 2011, 25 points was achieved, and your 40 points achieved minus 14 points. 2011 was a different year than other years, and it was the first time for Tigers that we used, instead of the 40-point target, we used a 25-point target, because there was a substantial level of uncertainty in that. And it was very interesting. 2011 was the first year in history that the Christmas trade failed as well. The Australian market didn't rally in 2011. 2012, 40 points was achieved, and if you went for 70 points instead of 40, you got 36 points. In 2013, your 40 points was achieved, your 70 points got you 32 points at the end of the trade. In 2014, your 25 points was achieved, your 40 points netted 18 points. In 2015, both the 40 and the 70 were achieved. In 2016, your 25 points was achieved. If you went for 40 points, you actually lost 10 points on that one. And that was actually a loss for Tigers. We did actually realise that loss in 2016. 2017, your 40 points resulted in 40 points. Your 70 points, we didn't quite make it, and we got 64 points for those going for 70 points. In 2018, your 40 points was achieved, but your 70 points got you 43 points. You were better off than going for 40, but you didn't get much more, and you carried a significant a significantly more or significantly higher risk because you're in the market for an extra 3 hours. Melbourne Cup 2019, your 40 points, you got it. Your 70 points, if you went for 70 points, you got 11 points at the end of the trade. So you can see there, it's constantly a winning trade. It's how much you go for. So there's no stops that have ever been reached in the Melbourne Cup. That doesn't mean they can't be reached for this one, but the history of the Melbourne Cup is that technically there've only really been 2 losses in the last 37 years. So 37 years, 35 wins, 2 losses, no stop outs, and so it comes down to what target do you choose to get across the line. And you choose the 25.1 one. That's $25 for every dollar you put in the marketplace, and that is great for some people. I have a tendency to choose the 40 points. It's the optimized amount for the rise, and if you go for 70 points, you've reduced your statistics substantially, but your win is substantially bigger. Now, one of the things with using CFDs and futures is that a little bit of money can make you a lot of money, but it can also lose you a lot of money. You're in a leveraged situation, and so your $1 is making you $40, but technically it could lose you $70 here. And so you have to have that money in your account. You can't bet with $1, only have $1. You've got to have the margin for it. So at the moment, if you have $1, you're going to make a trade for $1, you must have at least $100 because our stop's $70. We must have that, what we call a margin. Now, because we're going long and times are uncertain and we're right over the top of the US election and there's tensions with China, etc., we must use a stop. We can't go naked in the market, so to speak, and just go, oh, well, we'll just see how it happens. If there's a nuclear detonation in New York, if China invades Taiwan, the chances of these things are very, very low indeed. We would say less than 1%, but they're not 0%. And so we must have a stop, because no matter how good the Melbourne Cup is, on Monday night, if there's a nuclear detonation in New York, then our market's going to drop and there's no saving it. And you could have an unlimited liability here without a stop. If your account balance gets to 0, in City Index, they will automatically close you out. So the statement is you can lose more money than is in your account, but the reality is forcible closeout means in most situations your account, if it's reduced to 0, then your scenario is that you've lost your entire account, but not much more than that. It's a statement by all providers, not just City Index, that you must be prepared that you could lose more than your total account. Now, to manage our risk, we divide our account by 200 for the Melbourne Cup. So if I've got $200, I'll take 1 contract. If I've got $400, I'll take 2 contracts. And so if I've got $10,000 in my account, I can take 50 contracts. And then if I win 40 points, my 50 contracts will pay me 40 times 50, and that's $2,000, right? If I lose, I could lose $2,000 there. Now, the advantage with City Index for Investor Centre clients is we use a specific instrument from City Index, and it allows us to trade using basically the SPY, and City Index replicate that SPY for us. If we use other providers, then they'll say, oh, they have the top 200, you can trade that index. But if I use somebody like CMC or IG Markets or Axis ODL or 365. I'm not guaranteed, because they are made markets, they're not necessarily replicating the market that we're trading. I can use City Index, and that's a replicated market of the share price index future. I can use share price index futures, and there's no problem there at all. That's actually what we're trading. Now, index trading gives us predictable moves, opportunities to profit from both a rising and falling market. Volatility assists in our wealth creation with indexes. It eliminates the specific risk of individual stocks, and we decrease the requirement for specific knowledge. In other words, we don't have to read all about BHP or ANZ or Wesfarmers. All we have to do is worry about which direction the market is going to go, and when we think of it as we are trading the people that trade the shares that make up the index, you realize that we can actually become very, very successful with how the market behaves. And it's amazing how often the market does the same thing over and over again. Now, a big one for us, especially with some changes coming with ASIC and short selling and CFDs, etc., is short selling the index cannot be banned. And so this will always be available to us while there's a stock market. Now, once you understand the cycles that go through, you end up with, I used to have a large portfolio of shares, and now I just have a few shares, and I have a portfolio of indexes. And for a small amount of money, I can control risk for my portfolio, and I can follow seasonal moves like the Melbourne Cup move, like the US election. If you have a look, we've done some videos this week of all the election trades, and we've had 4 wins for 4 wins so far. And it's been a sensational week because we're trading what the people will do as they come into this US election scenario. Now, trading tigers, that's more than 20 mentored trades. And when I say mentored, I tell you how we do the trades, what's the structure of the trade, and then I send you out a bulletin, and Tigers have got a bulletin today telling them exactly what minute I'm going to enter for this trade, what my targets will be for that trade, what my stops will be for that trade, and when I will exit the trade. And I will carry out those instructions to the letter, and then I'll have a specific result. And they can actually do that, and I do that for more than 20 trades a year. That's what makes up Trading Tigers. And as we said at the very beginning, they're based primarily on behavioural mechanics, that the behaviour of a market is predictable in the future because it's made up of people, and people will do the same thing at certain times. So we have, in the Trading Tigers, we have specialised tools for IC Investor, our software package, and we average about 2 trades a month, and we aim for about 100% return a year from those 20 plus trades. Now, last couple of years, we've fallen a little bit short of that, down in the 80% return. So, each year has its own strengths and weaknesses. And certainly COVID has been a challenge for some situations this year. Now, just want to say congratulations to the people who followed me all this week and have done the trades. We're going to debrief them all on next week, Wednesday the 4th. We have the China trade coming up that will be starting just after that, the China A50 index trade. And that's a very good trade too. And we'll debrief every trade, including the Melbourne Cup trade, the gold trade that starts tonight, and what's going to happen between here and there. Our inversion trades have all won. They've been sensational. And so the night before last, we even got our 10% target, which was sensational. And as I said, the gold trade starts tonight, and we expect the bounce to start literally now. You can follow me on Twitter, Jody Ellis at IC Hot Stocks, and I've got free information, stock tips, and a bit of market information. Global Reporter you can subscribe to. We've just finished our audit and we've got 2,200% return, and you can actually contact admin and you can get every stock we traded for the last financial year, and you can actually see our 3 years of history. 2,200% sounds ridiculous, but that's pretty much 2,000% return is what we've been getting for the last 3 years from Global Reporter. Our day trading account, it's actually a bit lower than 62,000 from the $10,000 start, but that's available to you on the website at the moment. So trades for next week, we've got the China A50. We'll go through the China syndrome with you for Wednesday, the 4th of November. And make sure you've got a trading account ready if you don't already have. And if you don't have the trading account, contact the office on 1300 132 999 and go through to administration. Thanks a lot for watching, and I'll see you on the other side of Melbourne Cup. Good luck.